Stop scrolling right now because what happened in the precious metals market today is the kind of move that separates people who build wealth from people who panic at exactly the wrong moment. Gold just slipped below $5,000 an ounce. Silver crashed nearly 10% in a single trading session. The financial media is running headlines about the end of the precious metals bull run. And right now, millions of investors are staring at their screens wondering if they should sell everything before it gets worse. But here's what I need you to understand before you do anything. Moves like this usually look scarier than they really are. After a historic run in precious metals, a sharp correction is not just normal, it's healthy. And what we're seeing right now appears to be driven more by leverage getting flushed out and shifting Federal Reserve expectations than any real change in the long-term case for these metals. In this video, I'm going to walk you through exactly what triggered this sell-off and why the jobs report changed market psychology overnight, what the gold-silver ratio is telling us right now, and how to use it to make better decisions, why the smartest money in the room views days like this as opportunities rather than disasters, the trade uncertainty and geopolitical tensions that haven't gone anywhere despite today's price action, and how to think about positioning in precious metals without getting shaken out by moves that feel catastrophic in the moment but look like nothing on a longer-term chart. Now, before we dive in, if you're watching this channel and finding value in these breakdowns, take a second to hit that subscribe button. It helps the algorithm notice that people care about this content, and it helps me reach more people who need to see it. All right, let's get into what just happened. Gold fell 2.9% to $4,932.16 per ounce. Gold futures for April fell 2.8% to $4,953.66 per ounce. Those are significant moves for a single day, but let me put them in context. Gold has been on an absolute tear. We've seen prices that would have seemed impossible just a couple years ago. A 3% pullback after that kind of run is not a crash, it's a pause. It's the market catching its breath. But silver? Oh, silver. Silver fell 9.6% to $76.26 per ounce in a single session. That's the kind of move that makes people's stomachs drop. That's the kind of volatility that separates the serious precious metals investors from the tourists who came for quick gains and leave at the first sign of trouble. Platinum also got hit, dropping 5.6% to $2,025.70 per ounce. The entire precious metals complex sold off together, and it happened in the context of a larger risk-off move in equities and a flight toward bonds. So what triggered all of this? 2 words: jobs report. The U.S. non-farm payrolls data came in much stronger than expected. The print showed unexpected strength in the labor market, and immediately the market started repricing its expectations for Federal Reserve policy. When jobs are strong, the Fed has less reason to cut interest rates. When rates stay higher for longer, non-yielding assets like gold and silver become relatively less attractive compared to bonds and cash that actually pay you something. Right now, markets are pricing in a 94.1% chance that the Fed will leave rates unchanged in March. There's a 78% chance of the same in April. Those are significant numbers. The market is telling you that rate cuts, which were priced in more aggressively just weeks ago, are getting pushed further out on the calendar. The jobs report also sparked a bounce in the dollar. When the dollar strengthens, it creates headwinds for precious metals because they're priced in dollars. A stronger dollar means it takes fewer dollars to buy an ounce of gold or silver. Simple math, but it has real effects on price. Quick pause here. I want to know where you're watching from today. Drop a comment right now and tell me your location. And tell me honestly, when you saw gold and silver dropping this hard, what was your first instinct? Did you want to sell? Did you want to buy more? Did you just feel sick? Be honest, because your instinct reveals everything about how you're positioned in this market. All right, let me explain something crucial because this is where most people get the analysis wrong. Today's move was violent. It was sudden. It felt like the world was ending for precious metals. But let's look at what actually changed in the fundamental picture. Did the US government suddenly pay off its $30+ trillion in debt? No. Did central banks around the world stop buying gold? No. Did inflation suddenly disappear and the purchasing power of the dollar magically restore itself? No. Did the geopolitical tensions in the Middle East resolve themselves? No. Did the trade uncertainty between the US and China evaporate? No. None of the structural reasons for owning precious metals changed today. What changed was sentiment. What changed was short-term positioning. What changed was leverage getting flushed out of the system. Max Becker, the president of American Hartford Gold, put it perfectly. He said moves like this usually look scarier than they really are. After a historic run, a sharp correction is normal. This appears driven more by leverage getting flushed out and shifting Fed expectations than any real change in the long-term case for metals. Let me unpack what leverage getting flushed out means because it's critical to understanding days like today. When prices are rising, traders use leverage to amplify their gains. They borrow money to buy more gold, more silver, more exposure than they could afford with cash alone. That works great on the way up. But when prices turn when they start falling, those leverage positions get squeezed, margin calls go out. Traders who can't post additional collateral are forced to sell, and that forced selling creates more downward pressure, which triggers more margin calls, which creates more selling. It becomes a cascade, a self-reinforcing spiral of liquidation, and that spiral often has nothing to do with what people actually think about the long-term value of the asset. It's mechanical. It's about survival. When you're getting a margin call, you don't have the luxury of thinking about whether gold should be worth $5,000 or $6,000. You're just trying to stay solvent. That's what happens during violent corrections in any market, but especially in precious metals where futures leverage is significant and positions can get crowded. Here's the key insight though. Once the leverage is flushed, once the weak hands are cleared out, once the forced selling is done, what's left? Strong hands, unlevered buyers, people who own physical metal and don't have anyone demanding they sell, people who see lower prices as opportunities rather than threats. As Becker said, Wall Street may be getting forced out by margin calls, but long-term savers are being invited in at better prices. Short-term traders chase ticks. Serious investors focus on protection. That quote deserves to be repeated. Short-term traders chase ticks. Serious investors focus on protection. Which one are you? That's not a rhetorical question. I want you to actually think about it because how you answer determines how you should respond to days like today. Now let me talk about something that most retail investors don't understand, but professional precious metals traders watch constantly, the gold-silver ratio. This ratio is one of the most useful tools for understanding relative value between the two metals, and right now it's flashing signals that deserve attention. The gold-silver ratio is simple. You divide the price of gold by the price of silver. That tells you how many ounces of silver it would take to buy 1 ounce of gold at current prices. For example, if gold is at $5,000 and silver is at $50, the ratio is 100. Gold is priced at 100 times silver. Right now, let's do the math with today's prices. Gold at approximately $4,132 divided by silver at approximately $76.26 gives us a ratio of about 64.7. That's actually a relatively moderate ratio by historical standards. We've seen the ratio spike above 80 during periods of extreme stress, and we've seen it drop below 40 during silver bull market peaks. Why does the ratio matter? Because gold and silver often move in the same direction, but their pace is rarely identical. At times, one metal pulls ahead while the other lags. The ratio helps you see those moments. It helps you understand which metal is showing relative strength and which one might be due for a catch-up move. When the ratio is rising, it means gold is outperforming silver. Gold is getting more expensive relative to silver. Some traders view extremely high ratios as a signal that silver is relatively cheap and may be due for a move higher. When the ratio is falling, it means silver is outperforming gold. Silver is catching up or even leading. Today, silver got hit harder than gold. Silver fell 9.6% while gold fell only 2.9%. That means the ratio jumped today. Silver got cheaper relative to gold. For traders who use the ratio as a guide, that kind of move often signals that silver is oversold relative to gold in the short term. Now, I want to be clear about something. The gold-silver ratio is not a crystal ball. It doesn't tell you exactly when to buy or sell. As market analyst David Morgan once noted, the ratio does not predict the future, but it often reveals stress points where price relationships become unsustainable. Think of the ratio as a filter rather than a trigger. It helps you narrow your focus. If you're trying to decide between adding to gold or adding to silver, looking at the ratio gives you context. If silver has been hammered harder than gold and the ratio has spiked to an extreme, that might suggest silver deserves more attention. If gold has been lagging and the ratio has compressed dramatically, gold might be the more interesting play. Today's action pushed the ratio higher, which means silver took more pain than gold. For patient investors, that often creates opportunity. But you have to combine ratio analysis with price action. The ratio alone doesn't tell you whether silver has found support or whether it's going to keep falling. Let me ask you a direct question. Before today, were you aware of the gold-silver ratio? Have you been tracking it? Or is this the first time you're really understanding what it shows? Drop a comment and let me know, because I want to understand what concepts resonate with this community and what needs more explanation. Now let's zoom out from the daily price action and talk about the broader context, because context is everything. Yes, gold dropped below 5,000 today. Yes, silver got crushed. But where were these metals a year ago? Where were they 2 years ago? Even with today's drop, gold and silver remain well above last year's levels. The drivers behind this bull market, and I'm talking about government debt, inflation risk, central bank buying, geopolitical instability, currency debasement concerns, none of those have gone away. If anything, many of those factors are intensifying. Historically, sharp corrections in bull markets often set the stage for the next leg higher. Think about it. When prices run straight up without stopping, they build excess. They attract speculators. They create crowded positioning. A correction clears that out. It resets positioning. It transfers metal from weak hands to strong hands. And then the bull market can continue on a healthier foundation. I'm not saying that's definitely what happens from here. Nobody knows the short-term future with certainty. What I'm saying is that one day's price action, no matter how scary it feels in the moment, doesn't invalidate a multi-year structural thesis. Now let me talk about the other factors at play, because there's more happening than just the jobs report. Trade uncertainty remains a major force in markets. Reports emerged that US President Trump and Chinese leader Xi Jinping could extend their trade truce by as much as a year when they meet in Beijing in April. The summit is expected to focus on short-term economic wins, including fresh Chinese purchase commitments. That sounds like progress, right? That sounds like de-escalation. But at the same time, there are reports that Trump is privately considering exiting the North American Trade Pact, the US-Mexico-Canada agreement. That injects fresh uncertainty into pivotal renegotiations between the three countries. The agreement is set for a mandatory review before a possible extension on July 1st. So on one hand, you have potential de-escalation with China. On the other hand, you have potential escalation with America's closest trading partners. The net effect is uncertainty. And uncertainty, historically, has been supportive for precious metals. But here's the complexity. Uncertainty doesn't always translate into immediate buying pressure. Sometimes markets need to digest conflicting signals. Sometimes short-term moves are dominated by other factors like today's jobs report. The long-term relationship between uncertainty and precious metals demand doesn't disappear, but it can take time to assert itself. And then there's Iran. Safe haven demand for precious metals remained in play amid persistent tensions between the US and Iran. Both sides talked about some progress in nuclear negotiations over the weekend, but Washington is also preparing to deploy a second aircraft carrier to the Middle East. Trump has repeatedly warned Tehran to accept a deal. This is the kind of geopolitical backdrop that keeps a floor under precious metals even during corrections. When you're worried about military conflict in the Middle East, when you're watching aircraft carriers move into position, holding some gold and silver starts to feel like insurance rather than speculation. The question isn't whether geopolitical tension exists. It clearly does. The question is how much of that tension is already priced in and what new development might cause prices to move. Today, the jobs report dominated the narrative, but geopolitical events can shift the narrative in an instant. Let me pause here and ask another question. How do you factor geopolitical risk into your precious metal strategy? Do you think about gold and silver primarily as insurance against chaos? Or do you think about them primarily as investments with return potential? Your answer shapes how you should position and how you should respond to days like today. All right, let me talk about how to actually use the gold-silver ratio in a practical way, because understanding the concept is one thing and applying it is another. The ratio works best as a filter, not a standalone signal. Here's how many traders approach it. First, they identify the general trend. Is the ratio rising, falling, or moving sideways? This tells you which metal has been showing relative strength recently. Second, they look for extremes. Historically, the ratio has ranged from the low 30s during silver euphoria to above 100 during crisis periods, when gold acts as the ultimate safe haven and silver gets treated more like an industrial commodity. When the ratio reaches historical extremes, it often signals that reversion is possible. Third, they combine ratio analysis with price action. If the ratio spikes to an extreme while silver holds a clear support level, some traders prepare for a potential rebound in silver. The ratio tells them silver is cheap relative to gold. The price action tells them where silver might bounce. Fourth, they recognize when the ratio loses usefulness. During sudden, one-sided shocks, both metals can move sharply in the same direction without respecting relative value. Geopolitical events, surprise central bank decisions, or extreme currency moves can overwhelm ratio-based signals. During high volatility news periods, many traders step back from ratio analysis entirely and focus on basic risk management. Once markets stabilize, the ratio becomes useful again. The key insight is that the ratio helps you make sense of mixed signals when gold and silver stop moving in sync. It tells you which metal is leading and where short-term imbalance may exist, but it doesn't tell you timing. It doesn't tell you exactly when to pull the trigger. For that, you need price levels, risk management, and some judgment about market conditions. Today, silver got hit much harder than gold. The ratio jumped. That creates a potential setup for silver to outperform gold on any bounce. But that doesn't mean silver has bottomed. It doesn't mean you should leverage up and buy silver futures right now. It means silver deserves attention from ratio watchers. Whether you act on that attention depends on your risk tolerance, your time horizon, and your read on whether the forced selling is complete. Now let me address something that I know is on many of your minds. Should you buy this dip? Should you sell before it gets worse? Should you do nothing? I cannot tell you what to do with your money. I don't know your situation, your goals, your risk tolerance, or your time horizon. What I can do is share some frameworks for thinking about it. First, if you're holding physical metal with no leverage, you don't have to do anything today. Nobody is forcing you to sell. There's no margin call coming for coins and bars sitting in your safe. You can ride out volatility if your conviction in the long-term thesis remains intact. Second, if you're holding leverage positions, you need to be honest about your ability to withstand further drops. The worst outcome is getting forced out at the bottom because you sized too big. If today's move is causing you stress, that might be a signal that your position size is too large for your risk tolerance. Third, if you're sitting on cash and considering buying, remember that catching the exact bottom is almost impossible. Professionals don't try to do it. What they do is scale in. They buy some now, recognizing prices might go lower. They reserve capital to buy more if that happens. They build positions over time rather than betting everything on one moment. Fourth, think about your time horizon. If you're investing for the next decade, today's move is noise. It won't even be visible on a long-term chart. If you're trading for the next week, today's move is everything. You need to manage risk aggressively, know which game you're playing before you make a decision. The worst thing you can do is act like a long-term investor when prices are rising, and then panic like a short-term trader when prices fall. That's the recipe for buying high and selling low repeatedly. Let me share a perspective from the industry that I think is valuable. Becker from American Hartford Gold made a comment that stuck with me. He said that even with today's drop, the drivers behind this bull market, things like debt, inflation risk, and central bank buying, haven't gone away. And historically, periods like this often set the stage for the next leg higher, especially if the market shifts toward rate cuts or geopolitical tensions escalate. Notice what he's doing there. He's separating the short-term noise from the structural factors. He's acknowledging that yes, prices dropped today. Yes, it hurts. Yes, it's scary. But he's also pointing out that the fundamental reasons for owning precious metals remain intact. Will the Fed eventually cut rates? Almost certainly, at some point. The question is when, not if. Will geopolitical tensions escalate? Looking at Iran, looking at trade wars, looking at global instability, that seems quite possible. Will government debt keep growing? The trajectory suggests yes. If those structural factors remain in place, today's correction becomes a speed bump on a longer journey rather than the end of the road. Another engagement question for you. Looking at today's action, do you think we've seen the worst of this correction? Or do you think there's more downside ahead? I want to hear your analysis in the comments. What signals are you watching to determine whether this dip is a buying opportunity or a warning sign? Let me talk about what I'm watching next, because staying informed is how you stay ahead. First, I'm watching whether gold can reclaim $5,000. That's a round number, a psychological level. If gold bounces back above $5,000 quickly, that suggests the dip was just a flush and buyers are stepping back in. If gold struggles to reclaim that level, it might indicate more work needs to be done on the downside. Second, I'm watching silver's key support levels. Silver tends to be more volatile than gold. It overshoots in both directions. If silver can stabilize around current levels and begin to base, that could set up a sharp rebound. If silver breaks below support, the next leg lower could be equally violent. Third, I'm watching the dollar. A sustained rebound in the dollar will require more signs of resilience in the U.S. economy. Analysts noted that structural drags, including Fed succession uncertainty and broader U.S. policy risks, mean the dollar will still need additional upside surprises in upcoming data to sustain any rebound. If the dollar fails to follow through on today's bounce, that provides relief for precious metals. Fourth, I'm watching the next inflation reading. There's a key inflation data release coming Friday. If inflation comes in hotter than expected, that could shift the narrative back toward rate cut expectations, which would be supportive for gold and silver. If inflation comes in cool, the market might further reprice toward higher for longer rates. Fifth, I'm watching geopolitical developments. Iran remains a wild card. Trade negotiations remain a wild card. Any sudden escalation could trigger safe haven buying that overwhelms whatever message the jobs report was sending. The market rarely moves on just one factor. It's always the interplay of multiple forces. Your job as an investor is to track those forces and understand how they might interact. Let me bring this back to the practical level as we wrap up. Today was a tough day for anyone holding gold and silver. Seeing your positions drop in value is never fun. Seeing silver drop nearly 10% in a single session is particularly painful. But I want you to step back and ask yourself some questions. Did you buy precious metals because you thought they would go up every single day? Or did you buy them because you believe in the long-term thesis around monetary policy, debt, inflation, and geopolitical risk? If you bought for the short-term trade and you were using leverage, today was a lesson in humility. The market can and will punish overcrowded, over-leveraged positions. That's not a failure of the precious metals thesis. That's the market doing what it always does, transferring wealth from impatient hands to patient hands. If you bought for long-term protection, today changes nothing about your strategy. You hold through volatility because you understand that the path to higher prices is never a straight line. You understand that corrections are healthy. You understand that the best buying opportunities often come when fear is highest. The question you need to answer honestly is, which camp you're in. And if you're mixing the two, if you're telling yourself you're a long-term holder, but you're checking prices every hour and panicking at every dip, you need to get clear with yourself about what you're actually doing. One more thought before I close. The gold-silver ratio gave us a signal today. Silver got hit harder than gold. The ratio jumped. That creates a potential opportunity for silver to outperform on any recovery. Whether you act on that information depends on your circumstances and your judgment. But here's the beauty of understanding the ratio. It gives you a framework for thinking about relative value even when both metals are moving. It helps you make better decisions in chaotic moments. It adds context that standalone price analysis misses. If you didn't know about the gold-silver ratio before today, now you do. Add it to your toolkit. Watch it alongside price action. Use it as a filter, not a standalone signal. Over time, it will make you a more informed precious metals investor. Drop a comment below and tell me what you're thinking after today's action. Are you buying this dip? Are you holding steady? Are you getting out entirely? I read the comments and I want to understand how this community is positioned. Also, tell me where you're watching from. I love seeing how global this audience is. Precious metals are a worldwide market, and understanding how people in different regions view these moves helps everyone. If you haven't subscribed yet, this is the time. Days like today are when people decide whether they're serious about understanding precious metals or whether they're just along for the ride. If you want to understand, if you want to be informed, if you want to avoid the mistakes that cost people money during volatile periods, subscribe and turn on notifications. We've got more to cover in the days ahead. Friday's inflation data is going to matter. The geopolitical situation is going to evolve. The market is going to keep moving. I'll be here breaking it down and helping you make sense of it. This is Mr. Ag. Stay calm, stay informed, stay focused on the long term, and I'll see you in the next video.